My name is Alex Krzysztof. I'm the Director of Educational Programs with the Association. In this webinar, we continue discussing one of the most important parts of the research and development of any quantitative trading strategy, backtesting. We already discussed the premises of backtesting and its main features and limitations, and today we are going to consider a number of practical examples, a number of typical mistakes that developers make while backtesting, which may lead to serious inconsistency between hypothetical performance and live results. Let me remind you about the limitation of the applicability of backtesting. It is very often that backtesting results are considered as a guarantee of the future performance of a trading strategy. However, the only purpose of backtesting is to test the system's trading idea against historical data. Therefore, understanding how such a strategy would have performed during various market regimes that already happened. It doesn't tell us anything about the probability of this particular strategy to perform well in the future because it cannot test the strategy against possibly new market regimes which have been unknown so far. It is very important to remember because even the smoothest equity curve in the world cannot guarantee you anything in the future without understanding the reasons why this strategy used to make money in the given period of history. Assessing the probability of the future positive performance is part of the robustness assessment, and this is not discussed today. In case we would like to simulate any system, not necessarily even a trading system, first of all, we need to understand the physical processes associated with it. If we speak about trading, then in the first place, we should understand how trades are actually executed and also the differences between a hypothetical execution and a live one. Of course, on paper, we could assume that all trades would have been placed at the very price and at the very moment suggested by the strategy. However, reality may differ significantly. Our goal is to simulate this reality in most details. This way, we can indeed have a reliable backtesting. There are more obvious and less obvious sources of errors in backtesting. Obvious errors are mostly associated with incorrect simulation of orders execution. We will discuss only three most used order types here, partly in order to avoid going too deep into detail, and partly because most of other order types can in fact be derived from these three. As to less obvious sources of errors, we will discuss what may happen in case the system clock is not synchronized with the exchange, and perhaps the most important and yet very often overlooked error, an attempt to generate multiple orders in a single bar. Of course, this error is relevant only to software which operates bars as the minimal elements of price time series. But on the other hand, most of modern software does exactly this. Let's start with stop orders and issues associated with them. Brokers and exchanges use various implementations of stop orders, and for clarity's sake, it's always best to simply ask them directly about the way they execute stop orders. However, this is an ingenious order which is executed at a price which is worse than the order level. Normally, such an order is executed at the first tick above the order price in case we want to buy, or at the first tick below the order price in case we want to sell with a stop order. Sometimes stop orders are executed when a certain number of ticks are above or below the order price. Very often there are no stop orders at all. Such a virtual order is converted into a market order as soon as the order level is hit. We will stick to the classical definition because this is the way stop orders are implemented in almost all backtesters, and understanding how to properly manage associated issues will give an idea how to backtest a strategy if another execution method for stop orders is used. Let's imagine a hypothetical sequence of ticks shown above in this slide. We can see that price oscillates up and down, and not always there are ticks at each price level. There are a number of explanations to this phenomenon. In exchange-traded markets, it's caused by a momentary lack of liquidity. In ECNs and other market maker priced markets, it's caused by very quick changes of bids and asks posted by liquidity providers and so on. Nevertheless, as the result, in this particular case, the stop order will be executed one tick above the order price. This phenomenon is known as slippage. How could we account for slippage to make backtesting results more reliable? One of the ways is, of course, to use raw tick data from the exchange, in case such data is at all available. However, it will require a lot of computer power, and unless the strategy has zero tolerance to execution issues, such a test could possibly be simply redundant. It's much easier to simply subtract a certain value from each trade's profit or loss to simulate slippage. In the roughest approximation, we can use a constant value. If we want to be more precise, then of course we should use different values for slippage depending on different market conditions. Which value should we use for slippage? Normally, it's always a good idea to monitor the liquidity in the order book throughout the day because liquidity changes depending on time. If the strategy generates trades during the time when the liquidity is low, it's always a good idea to use different slippage for different times of the day. For most liquid markets, however, and most of strategies which generate trades during the most liquid time, it's normal to just subtract one tick to get a reliable simulation of trades. Now let's consider another type of orders, limit orders. According to the classical definition, a limit order is the one that is always executed at a price better or equal to the order level. Therefore, even if any slippage may occur with the limit order, it would be positive. This may happen in case the very first tick that crosses the order level is already beyond it. So, when we try to simulate limit orders, we don't need to subtract anything from the trade's profit or loss. The main problem with the limit orders is of the different nature. Limit orders may not be executed at all. In order to understand how it may happen, let's look at the order book. In fact, the order book, or depth of market, is two-dimensional. This means that the amount of contracts at any price level is represented by a number of separate orders. And these orders are accepted by the exchange and put into the queue on first in, first out basis. Therefore, when you just submit your limit order, it always goes to the end of the queue. And for it to get actually executed, it's required that all other orders in front of it were executed. Thus said, if the price in the historical data hit the limit order level, it doesn't mean that in reality such an order would have been executed at this very price at this very moment in time. How could we make sure that the limit order in reality could have been filled where appropriate? Basically, there are two workarounds, similar to the situation with stop orders. First, we can use tick data from the exchange, and it seems like the most accurate method. However, Even time and sales data always have numerous inconsistencies, and quite often it's hard to rely on backtesting done using this data. A less burdensome solution is to suppose that the limit order was filled only in case the price went beyond the order a certain amount of ticks. Most of modern software support this feature for backtesting. Only you should be very careful with it, as some software not only do not execute a limit order in case the price didn't cross the order level, it cancels the order. And even it would have been triggered a few ticks later, the backtester wouldn't execute it. So you have to manually control the order execution right in your strategy code. When you send a market order, you basically say, buy or sell right now, regardless of where the price is. Obviously, market orders suffer from the same disease as stock orders, but at the same time they may be executed with a positive slippage, quite like limit orders. Again, as in case with the other two order types, it's possible to build very complex models which account for various market conditions depending on the liquidity distribution during the trading day, and then make more or less reliable hypotheses about probability of a negative or a positive slippage for a market order. And it is possible to simply always subtract a certain value from each trade, a value which is definitely greater than the maximum possible slippage. This way, you will always have a backtesting which is worse than the reality. And of course, it's better than having a backtesting which is better. Now let's talk about certain issues pertaining to live trading which are very hard to properly account for during backtesting. One of these issues is synchronization of the computer clock with the clock at the exchange. Of course, the best solution in this case is to always use timestamps which come with the data. But in certain cases, it appears to be impossible to do. We are not going to discuss these cases as it would have led us too deep into specific technological issues, but for example, certain data feeds allow to receive every tick only without a timestamp. In this case, the correctness of data compression solely depends on the accuracy of the computer clock. In this example, we can see how differently bars may look in case the computer clock is only several seconds behind or ahead of the clock at the exchange or a broker or an ECN or a data feed or whatever. In this case, in this example, we can see that the 30-minute bar closes up according to the data with the correct timestamps and down in case the data was aggregated in bars locally using the local computer's clock. Of course, if a trading strategy uses closing prices of bars for calculating entries and exits, then in case a trade could be generated on this bar, it would not have executed in real life and vice versa. Therefore, we should ensure that the computer clock is always synchronized with a reliable source, preferably a good NNTP server. And finally, let's discuss the issue which is quite possibly the most dangerous and the most misleading in backtesting. It's very difficult to locate such an error, and yet this error is the very one which allows to create strategies with hypothetical equity curves look outstanding on paper and not tradable in reality. I mean the situation when two or more trades are placed in the one same bar. Typical reasons which cause multiple orders to be generated in the same bar are too tight stops, too narrow profit targets, and an incorrectly chosen time frame. Normally, it may happen if the strategy uses a stop which distance from the entry price is smaller than the average range of the bars in the chosen time frame, or a target which is again smaller than the average range of bars in the chosen time frame. Therefore, we can generalize this issue saying that it is mostly caused by an incorrectly chosen time frame or, in general, data compression. In order to better understand what may happen if multiple orders are generated in the same bar, and also to see how easy it is to run into such an unpleasant situation, let's consider an example. This is just a sample strategy, which of course doesn't make money, but wonderfully illustrates the issue. We use a limit order to sell, and in case we have a position, we liquidate it immediately at the open of the next bar. If bars, in this case, represent days, it starts to make some sense. We're trying to sell at a price which is higher than the current and liquidate the position at the open of the next day. As many books and tutorials teach, we use both the stop order and the profit target order. Okay, now when we look at the entries and exits shown on the chart, it seems like we have found a really good working strategy. Indeed, first, the entry limit order is triggered and we have a short position. Then, the exit limit order is triggered and the profit is taken. As we can see, even with the naked eye, these limit orders would have been executed in reality as well, because price definitely was beyond the order. So, is this picture really so good? Of course not. In case we can see more than one order in the same bar, it's always essential to understand the sequence in which these orders would have been triggered in reality. For this purpose, we always need data at lower resolution, the one which eliminates the chance of two or more orders to be simulated in the same bar. Some advanced backtesting software is capable of doing it automatically. Others require the strategy code to be modified to work on data with a lower resolution. If we now make a reliable test using 1 minute resolution of data, then we can see that in reality, the price has never reached the target exit after the entry, simply because it changed in a different way inside that day. Therefore, instead of exiting with the target, with the profit, in reality, this strategy would have exited with a loss at the open of the next day. Even without discussing various issues associated with placing orders at exactly the open of the market, it's clear that allowing multiple orders at the same bar may change the hypothetical performance so dramatically that it may become useless. So now let's briefly summarize what we have discussed today. First and above all, you should always correctly choose the data resolution for your backtesting, regardless of the actual data compression format. It may be time bars, or volume bars, or range bars, or even more sophisticated data compression. In any case, you should avoid multiple orders to appear in the same data sample, or simply in the same bar. Next, I recommend to avoid using limit orders in your strategy at all because of the high risk of getting unrealistically good backtesting results. And of course, please don't forget that no so-called tick emulation that is suggested by some modern software is able to provide reliable backtesting results in case the prerequisites for correct backtesting were not met. So this is more or less all that I wanted to share with you today. And as always, if you want to learn more about not only backtesting and optimization, but about systematic trading in general, but to be more proficient in systematic and algorithmic trading, you're always welcome to visit our pages dedicated to our educational program for systematic trading that is located at http://atissn.com/classes. And of course, please feel free to send any questions to info@atassn.com. Also, don't forget to subscribe to our YouTube channel, where at least most of the past webinars are uploaded. The address again is very simple, youtube.com/ATASSN. So thank you very much for attending today's webinar.